All right. Good evening, everyone. Welcome to tonight's webinar. I am your host and MC. My name is Brian, and I'm a dealer here at Philip Capital. Now, before we get started, let me just bring you through a quick introduction to Philip Capital as well as the services that we provide, and then I'll pass it straight on to our esteemed speaker for the session. Okay, so first off, this is just a disclaimer that this presentation has not been reviewed by the Securities Commission of Malaysia and is only a presentation for educational purposes only. It is not any investment advice for you to buy or sell any products. If you wish to dabble in the world of trading and investing, please consult a licensed financial advisor. Hence, PCSB and the speaker, we are not liable for any investment decisions that you may make based off the presentation. Okay, so just a bit about Philip Capital is that we were incorporated on the 7th of October 1995, and we are a wholly owned subsidiary of Philip Capital Holdings and Berhad. Formerly, you may have known us as Philip Futures, and that's because back then we only offered futures and CFDs, but as of recent, we have started to also offer stocks. We are a trading participant of Bursa Malaysia, as well as a participating organization of Bursa Malaysia Securities Berhad. We are also a holder of the Capital Markets Services License, which means we are legally allowed to offer you these products and services. One second, I think. Let me try my microphone real quick. There seem to be a few questions on. Okay, my mic is working fine. Thank you for your comments. Okay, let me restart the screen sharing real quick. It seems that it didn't share for a few attendees. Okay, you should be able to see my screen right now. Pardon for that technical difficulties, but I'll get straight back into the introduction. Okay, so as of now, we have 11 Flip Investor Centers across Malaysia. So we have offices scattered all across West Malaysia and East Malaysia. So if you are nearby any of these branches and you wish to drop by to talk to any of our dealers, you can do so really easily. We have offices in, JB, Klang, Kota Damansara for West Malaysia, as well as for East Malaysia, we have branches in Kuching, Cebu, as well as Kota Kinabalu, and our headquarters are located in KL. All right. So here we have the track record for our award-winning Bursa Excellence Awards. You can see that we've won multiple awards throughout the years. And as of recent, we have won awards in the Best Overall Derivatives Trading Participant, as well as the Best Retail Derivatives Trading Participant for last year. All right. So we have a wide global network. We have offices all the way from Western countries like France, UK, the US to actually what this means is that we have a wide global coverage. If you have any products that you wish to trade from any of these exchanges, like the CME Group in the US, Eurex, ICE Exchange, SGX, you can actually do so through us. We are a kind of like a middleman, as a broker. So any of the products listed on these exchanges, you are able to trade them through us. So we are your one-stop solution for your trading because first off, we offer a wide array of products. On the left, you have futures, things like index futures, agricultural futures, metal futures, to the good old equities and stocks like local Malaysian shares or foreign shares like US, Hong Kong, Singapore shares, to the CFDs where we have Bursa shares CFDs as well as the NYSE and Nasdaq shares CFDs as well in our product list. Hence, I think that we are your broker of choice because we are not only an award-winning multi-asset broker, but we also offer 24-hour broking and execution support for our clients, as well as advisory services with the latest market news updates to make sure our clients are up to date with the current market movements. So if you are interested in our advisory services, you can actually learn with Philip Capital. We offer free one-to-one coaching sessions, free seminars and webinars, as well as a guided process for our free online account opening portal. So just a bit on the free one-to-one coaching session. It's mainly going to be divided into maybe a session or two where we bring you through product knowledge, such as an introduction to futures, CFDs, and stocks, or a charting system guide where we'll coach you through our trading platforms. So if you are interested in joining the future upcoming seminars and webinars, you can scan this QR code right here, or you could also find the full list on our website, flip.com.my. I will stay here for a few seconds and then I'll move on to the next slide. So do snap a picture, but if you do miss it, it's fine. Just go on flip.com.my. All right, moving on. Here we have our weekly market calls, where on the left you have our analysts present his or her weekly views and updates about newly published reports. And on your right, you have the live counter technical analysis, which is presented by our technical analyst, Mr. Zain Al. On your left, it's every Monday at 11 a.m. And on your right, it is every Monday at 8 p.m. just at the New York Open. All right, moving on. If you are interested in trading any of the products, you can actually open an account with us anywhere, anytime at your own convenience because we have an online account opening portal for you to access right there. So it's really quick and easy. Just scan this QR code and it will bring you through that website. Okay, so before we move on, let me just show you a bit about our own in-house trading platforms. So first off, we have FlipNova, which is the platform that our clients use to trade futures, right? It is both on desktop as well as mobile, and as well as on the Apple App Store and the Google Play Store. So if you're interested for a demo account, you can scan this QR code right here. All right, moving on. We are also proud to present that we have actually partnered up and linked ourselves with TradingView, where actually we have taken the interface from TradingView and we've slapped it onto our platform for the charting part of TradingView. As people know that everyone loves TradingView, so we've taken the best out of that and then we've slapped it onto our platform. Apart from that, we are also the only broker in Malaysia to link with TradingView, meaning you're able to actually trade and execute your trades on TradingView, assuming you have purchased their pro versions as well. So you could do that through us. Okay, next up we have the Poems Global MY 2.0, which is our latest newly refurbished stocks platform. So currently the desktop version is 2.0. We are still in the works of making it 3.0, but we have launched our mobile version first, which is Poems Global MY 3.0, which is our newly refurbished stock trading platform with a modern looking interface. It is also both on the Apple App Store and the Google Play Store. If you're interested, you can download them right there. All right. So next up, last but not least, we have the Flip CFD Trader, which is the platform our clients use to trade CFDs. All right. Last but not least, promotions. Everyone loves promotions, right? Regardless of what industry you're in. So why not get some great promotions in trading? So first off, we have the CME promotions, where if you open an account, you can get rewarded 100 ringgit touch and go reload pin. Of course, this is for new clients, and new clients have to deposit a minimum of 5,000 ringgit into their trading accounts and subscribe to the CME exchange, right? TNC supply. You can visit our website for more information. Next up, we have the Trade BMD futures, Trade and Triumph, where you can win up to 1,050 ringgit cash rewards if you trade any of the Bursa Malaysia listed products. You can scan this QR code for more information if you are interested in that. It runs until the 30th of October, so you have one more month left. Okay, last but not least, we have the CFD promotion running from 9th of September until the 12th of December of this year, where you can get commission rebates of up to 80% and as low as $2. You can scan this QR code for more information, and you can also find them on our website. Okay, so finally, we've gotten into the core content. Before I pass the floor to our speaker, let me introduce our esteemed speaker for today, Mr. Daniel Ang. So, Mr. Daniel Ang started his career trading commodity futures back in 1985. He went on to be a gold dealer in 1989 before joining Standard Chartered in 92, where he traded mostly US futures as well as FX and became one of their vice presidents. He is currently contracted to the CME Group as an independent speaker for the Asia Pacific region as well as for the Frankfurt based UREX. He is also the author of The Accidental Trader, a book available at major bookstores in both Singapore and Malaysia. We welcome with us tonight the founder and CEO of Traders Academy International Proprietary Limited, Mr. Daniel Ang. I'll pass the floor to him.
Thank you very much, Brian, and a good evening to all of you who are logging in. And Brian, if you may, can you allow me to share my screen? Thank you very much.
Yep, you should be
And
able to do so. Yep.
right, I hope you guys can see my screen right now. Hang on. Are you able to see my screen?
Yes, we are,
All right, thank
but
you
it's
very
not in
much.
the presentation mode.
It is not. Okay, hang on. It should be, but it is not. All right. Not sure why this is the case. Earlier on where we tested it out, it was okay. Is it in the presentation mode right now? Can you just let me know? Brian, are you able to see the presentation mode right now? All right, I assume you guys can see because nobody seems to be telling me otherwise. All right, and okay, let me go back a bit on the very beginning. All right, this is a presentation. We all understand this is the week after the major decision by the Federal Reserve to pivot. And the title of today's presentation is The Fed Pivot, What's Next? We all know that the Fed has maintained a very elevated interest rate policy for exactly 30 months since March of 2022, right after the start of the war in Ukraine. And it's no accident that is the date in which there's a timing in which the Federal Reserve decided to hike interest rates, and that has been ongoing for 30 months. And finally, uh, data coming in suggested the U.S. economy may be slowing down, and this is basically why the motivation behind the Fed pivot. Now, before we go any further, I just want to reiterate what Brian has said earlier on. Now, this presentation is not an offer to buy or sell any securities, especially futures or options. And these instruments are definitely leverage margin products, and they do carry risk. So all of you are advised to ensure to consider your own suitability before you attempt to trade any kind of margin products. And I'll be sharing you my views and opinions about the various markets. And today we'll be concentrating on US equity market and how we can use the CME Micro E-mini equity index futures to actually take advantage of what I think is going to happen. Okay. And these are my views and have got nothing to do with the sponsor, which is CME Group, as well as the host, which is Philip Capital Malaysia. So again, these are not to be construed as investment advice, and we will not be accepting any responsible
Hi,
whatsoever
sorry,
for
Daniel.
any
Sorry to
action.
cut you off. I think you're sharing the wrong screen. It's not in the presentation mode as of what I'm seeing right here.
Oh, this is not good. Hmm. Right. Let me do this again.
Yeah, so I think you have to present it first, put it into the mode first, and then you could share that screen.
Let me do it all over again, just
Yep,
to be
no
on the safe
problem.
side. By the way, I'm going to disable my camera just to make sure that we have more bandwidth for this. Now, for some reason, I'm not able to get up to that level where I can share my screen effectively. I beg your pardon for this because I'm not familiar with GoToWebinar. Let me see. Are you still able to see my screen?
Yeah, so I think you could try to, not as of now, no.
Hmm.
I think you could present the PowerPoint first, and then you could swap over to that correct window.
Well, I only have one window. Anyway, let me do
Oh,
this
okay.
in not in presentation mode in this case, so they make it easier for all of you. So what I can do here is to present in this mode. Now, it will not be in
All right.
presentation mode, but I will have to toggle up and down, okay? Anyway, the Federal Reserve has a dual mandate, and one of the dual mandate that the Federal Reserve as a central bank of the United States have is actually to maintain price stability, meaning to say they are always looking out for sign of inflation. We all knew right after the start of the war in Ukraine, there was elevated inflation, and that persists all the way to June of 2022, where the headline CPI numbers in the States was at 9.1%. So that was a little bit drastic because when we knew at the start of the lockdown, we knew that there was a breakdown in the global supply chain, and that was also contributing to the elevated inflation that we see globally. But as far as the United States is concerned, 9.1% is definitely a little bit extreme. So the Federal Reserve tackled that by hiking interest rate very aggressively from near zero all the way up to 5.5%. So they maintained the 5.5% Fed fund rate for a long period of time. And we knew 2 months ago, where the non-farm payroll was released, that the label numbers suggested the U.S. economy is slowing down, and we can see all other major central banks starts to cut interest rates. So the Federal Reserve is probably one of the very last to actually act on the rate cut. But they finally did it last week. Yeah, if you remember last Wednesday, during the FOMC meeting in the wee hours of the morning, the Federal Reserve finally cut rates from 5.5% by 50 basis point all the way to 5%. So that is the start of what analysts is thinking is going to be the start of a new rate cutting cycle. There will be implication for equity markets. Not only equity markets will be, yeah, impacting all other markets as well. So today's webinar will be concentrating on just the equity side of the metrics. Okay. Now the other mandates that the Federal Reserve has to maintain is to ensure that the economy chugs along happily, and meaning to say that they need to see maximum employment. Now this is the reason why we are seeing a Fed pivot. The headline US unemployment rate has actually surged, okay, to 4.3%, something that we have not seen since the start of the pandemic. Okay, of course, pandemic was a one-off. We can see there was a wholesale collapse in employment in the states itself, but now we are back to pre-COVID levels, and 4.3% is definitely something we have to watch, because every time we have a onset of elevated unemployment rate, it has almost always led to a recession. So all this talk about having a soft landing, it is still going to be valid. Okay, this is what we could be exploring today. Okay, let me go back to the next slide. Now, this is the headline US inflation. We have year over year, which is the one that we all want to watch. And we all have to understand there are a couple of inflation measures. And this is for retail investors. This is possibly the most watched number. Okay. However, do understand that the Federal Reserve is not basing their forecast as well as their decision on this number. But for retail investors, we are always looking at the headline numbers. There are two lines you can see here. One is the core CPI, which is a light blue line. The other one is a darker blue line, which is the core PCE numbers. Now, both are inflation measures. For the retail investors, we are almost always looking at the blue line, which is the core CPI numbers. Now, CPI numbers, if you look at a core, meaning to say that we take away the food and energy component, which tends to be very volatile, to get a better reading of the state of inflation. We can see that the curve has been falling. In fact, it has been falling since June of 2022. And the target rate, you can see at the bottom of this chart here on the right, is a target rate of 2%. We are definitely coming down. You can see in terms of the rates, the CPI number is definitely coming down, but we are nowhere near 2%. And as far as the Fed is concerned, 2% is still their target rate. Okay, whether we can get to 2% remains to be seen. However, the curve does suggest that inflation has been gradually coming down in the right direction. Now, the other dark blue line refers to the core PCE number. The PCE refers to the personal consumption expenditure, which is the number that the Federal Reserve do watch, and they will decide on whether they do anything on the monetary policy front based on the development in the PCE number. The core again refers to taking out the food and energy component of this index, and it has stayed flat. Okay, you can see for 4 months now, since May of this year, the core PC number has gone flat. Now, gone flat means either it has plateaued before it dip again, or it has plateaued forming a base before it goes up. So nobody knows whether inflation is going to resurface. But the fact that the Federal Reserve has cut the Fed fund rate by 50 basis point, there is a risk here, because if you cut interest rate, there is a danger of a resurgence in inflation. Okay, so whether or not the Federal Reserve will be maintaining more rate cuts for the rest of the year remains to be seen, although market do expect them to continue to cut. Okay, so this is the situation we are facing right now based on this data. And the next one we're going to be talking about will be the labor report, which is the non-farm payroll. Now, there are two sets of numbers here. In this particular chart, we have the light blue bar referring to the number of jobs created for the non-farm sector, making the farm sector has been very volatile because it's seasonal. So we can see that the number of jobs created has actually dipped since March of this year. On average, we are looking at 142,000 jobs being created for the month of August, and this has been revised. This will likely to be revised in the first week of next month. Okay, so we will look at this number. However, the previous number for the month of July has been revised downwards. So this has been a pattern in which we see the headline non-farm payroll came in and the market got excited, to those numbers, and subsequent months, very quietly, the Bureau of Labor Statistics revised those numbers downwards. Okay, that has been a pattern. So it calls into question whether the reliability of this data is it going to be still be useful. Okay, now we can say the other data in this chart here is the dark blue line, okay, which show that the unemployment rate went up to as high as 4.3%, like I mentioned earlier on. That was in July. Okay, the last number is 4.2% for month of August. Again, these numbers will be subject to revision. The next one we'll be looking at will be next Friday. So based on this data, in which the number of jobs being created has been progressively been revised downwards, suggests that the US economy is not creating that many jobs, and it does suggest that the US economy may be slowing down. Remember, the Federal Reserve has a dual mandate. One is to make sure the employment situation remains stable so that the economy can chug along nicely. Okay. So now we go to the next one, where we talk about the fact that the Federal Reserve has been not the Fed, the Bureau of Labor Statistics has a habit of revising downwards the figures for the non-farm payroll in terms of jobs created. Now on the left of this slide here, you can see there are a couple of bars here, and we can see light blues and dark blue bars here. Now the light blue are the actual headline non-farm payroll numbers that was released. Now over the last 14 months, okay, since March of 2023, we can see that there are only two occasions in which the revision which comes in the month after has been revised upwards, meaning to say that of the 14 months that you can see here, 12 months the revision has been downwards. So there is a trend here in which the Bureau of Labor Statistics do revise those headline numbers lower in 12 of the last 14 months. So this is creating a situation, and a bombshell was actually released when they finally give us the confirmation. This is the news that came in on August 21st, which is exactly 1 month ago. We can see that the bombshell was the Bureau of Labor Statistics finally confirmed that their estimates for the preceding years, from March 2023 to March 2023 this year, they have over-reported something like 818,000 jobs. And this is big, because if you have over-reported 818,000 jobs, and market has reacted to those better than expected numbers. Now you come in and let the world know that you have over-reported by more than 800,000 jobs. It does give a analysts as well as investors something to consider, because the economy is definitely not as strong. They did not create so many jobs, and this is also leading to the narrative in which are we still looking at a what we call a soft landing. So the soft landing refers to no recession, whereby the labor market is healthy, inflation is coming down, so everything is lovey-dovey. We are in a Goldilocks situation. Now with the bombshell that we know last month, in which the economy did not create that many jobs, and that called into question whether a recession is on the way. Okay, so far there is no sign that there is a recession, but I think investors will be well advised to take a look at this possibility here. Now, this is the GDP numbers for the US economy, or since Q1 of 2023. We can see that the latest Q2 numbers, which will be again be revised. There will be a third reading this week itself, and the last second reading was that US GDP for Q2 of this year was at 3%. Now, 3% for a very mature economy like the United States is actually a very, very good number. But however, we will have to watch whether there will be any downward revision. Now, Q1 wasn't as great as Q4 last year. Q1 was 1.4%. Now, consider that it was 3.4% in Q4. So that was a massive markdown in the Q1 number. So now Q2 has recovered back almost all its losses in Q1. So let's see whether this week itself, when the third reading of these estimates is finally announced, whether there'll be any drastic change in this number. But based on this number, we can see the US economy is doing okay. Okay, so again, based on official data, uh, it does looks like everything is fine with the United States economy. However, when we look at the other data sets that comes in periodically week after week, we also see disturbing signs that the data does not correspond to this very bright outlook in the United States economy. Okay, so now let's go to the next one. Okay, this is the US consumers. Okay, now of course we all know US economy is a consumerism economy. If the US consumers do not spend, the GDP will not expand. Okay, so it is very much based on US consumers spending. It is a economy that survive, or rather performs by how much the US consumer open up their wallet to actually spend. Now here we have two sets of data. Here we have the real personal consumption expenditure. Now remember earlier on, one of the numbers that we looked at in terms of inflation is the personal consumption expenditure. We can see that expenditure has been expanding. So this is good. Okay, if you look at this data, it has been climbing, basically telling us that US consumers are confident about their future and they are still spending. However, this other data sets that comes in that suggest that US consumers are spending mostly on basic needs. And this could be troubling because if US consumers are not spending on durable goods, for example, that means to say that their spending purchasing power has actually not increased, and that is the reason why they are only spending on basic needs. Now the other one is US consumer borrowing. Now this is a reflection of whether US consumers are spending on credit, and there is that sense. You can see at the chart on the right where the red line is. You can see it has been climbing very steadily at the same time where US consumer expenditure is also increasing. So this is evident that suggests that US consumers are actually charging all their expenses to credit cards, and this is never a good thing because we know interest rates are elevated, although the Federal Reserve has started to pivot. But you can see that US consumers interest rates, especially as credit cards loan is concerned, they are not fixed. Okay, so we are looking at elevated borrowing costs, and this will actually crimp US consumers' desire to spend. So this will have implication going forward. And of course, the Fed has actually pivoted and cut interest rates, but do understand that the cut in interest rate at the wholesale level will take some time to filter down to the consumer levels. Banks will not react immediately by cutting their loan rates. Okay, so it will be some time before consumers will actually benefit from the pivot by the Federal Reserve. So just be aware that this is not immediate. It will take some time to filter through. Now, this is the consumer uh, delinquency rate. We can see that the number of people who are behind paying off their credit cards is also rising. Okay, so we can see that the percentage of where we are right now, based on the latest data set from the Federal Reserve Bank of St. Louis, we can see that currently there is an increase in delinquency rate. Delinquency rate is defined as anybody who are 3 months behind in paying off their credit card loans. Okay, so this is computed by the Federal Reserve itself, by the St. Louis branch of the Federal Reserve. And this is again very worrying because it confirms what we already know, that US consumers are basically spending on credit card. And there are also a sign that the consumers are not paying off the loans on time and they are behind. So this is one sign in which we will have to understand that US consumer is not as strong as what we the data set is telling us in terms of the GDP. Okay, so again, something to consider. Now, we also want to look at these other issues here, which is what we call the CRE crisis. Now, CRE refers to commercial real estates, and for some time we already know that US consumer, no, US commercial real estate is in trouble because the borrowers, the lenders who actually take loans to purchase commercial buildings has been negatively impacted ever since the lockdown. Now, during the lockdown, there is something else that happens businesses encourage their employee to work from home. Now that the economy has got back to normal, people are going back to offices. Now there is a trend whereby people are resisting the attempt by companies to get them to go back to office, and that has also directly impacted negatively the occupancy rates of commercial buildings. So borrowers that borrow to actually buy or purchase commercial buildings are finding that they are not able to collect enough rent to justify. And we know that for the last 2.5 years, interest rate has been very, very high, and there is the danger in which these borrowers may default because, again, commercial loans are a little bit longer. The time for renewal of their mortgage loans will come in very, very soon, and there is a mountain of mortgages that will be due for refinancing. Okay, and if that's the case, then the new high rate of mortgage loans is going to be a burden on the US economy. As much as 80% of these commercial loans for the real estate sector actually comes from the smaller banks. Okay, so the smaller banks are going to be the Achilles heels if something bad do happen in the commercial real estate sector. Now, if you remember last March we have a mini scare, okay, in which smaller banks, smaller regional banks got into trouble because they are caught between uh, having already bought very low yield bonds during the period of almost zero interest rates, and as interest rate goes and those bonds were basically underwater, and they actually saw a couple of bank runs which actually has a knock-on effect, and that was last March. And there's a sense that we are not over that crisis just yet because, like I say, a mountain of new mortgage refinancing is coming up from now all the way to beginning of next year. So we can see that this is something that we will also have to watch because it's again something that they may actually upset the apple cart, so to say. So this is an article that came in at the beginning of this month. It said rate hike by the Federal Reserve and changes in post-pandemic behavior has put pressure on the CRE sectors. Borrowers need to refinance their loans, okay, which is coming due. Okay, so this is an article that confirms what I've just shown you in that sector. Okay, now let's take a look at the US national debt. Now this is something that we also have to be concerned with. We have known that the US consumers, that they not only the US consumer had delinquency rate, we can see the US government has actually piled on debt. This is quite alarming because it took the United States so many years just to accumulate $1 trillion in debt. Now we can see over the last 4 years, since the Donald Trump's administration, we can see interest this national debt has actually escalated, and over the last 4 years, okay, during the first term of the Biden administration, that trend has actually accelerated. The last known number, okay, is 35 point odd trillion dollars, and this is a ongoing development, and this is something that we will have to consider because the U.S. government borrowed in just the last 12 months something like $2.4 trillion, and this is unimaginable because at some point this will come. With the US government and the markets will have to deal with this issue. There is a risk that the US government may not be able to service this debt at this current rate of expansion because right now the interest on servicing this mountain of debt is $1 trillion, and this is a little bit scary. Okay, 1 trillion, by the way, is 12 zero. Okay, a lot of people cannot wrap their head around a trillion dollars kind of debt, okay, in terms of the interest they had to pay. So if the government had to spend more money servicing debt, they have less money to spend on other critical programs, or whether it is to alleviate poverty or for any of the infrastructure project which they solely need. Okay, so this is something that will take away the resources from the US government to tackle what they need to spend on. Okay, so if this is the case, at some point we would have to see how the US government will actually tackle this. And there are also signs that there is something called de-dollarization going on, and this is especially so right after the start of the war in Ukraine, in which the West, particularly the US, has actually sanctioned the Russia, and and basically freeze their national reserve. And this has actually spoke all other countries in which they are now trying to future-proof their relationship with the United States by getting rid of U.S. dollar assets, and in particularly their U.S. Treasury bonds, which has always been deemed to be a very reliable, very safe investment. Now people are looking to divest from that. China has been divesting their holdings of U.S. Treasury for some time now, and we also see their hardcore ally in terms of Japan has also been doing the same thing of late. And of course, Japan is also battling their own battle in terms of their collapsing currency. Okay, for some time we can see that the Japanese yen has been collapsing, and it's only over the last 2 months. In August, we can see that the Japanese government has, or rather, the central bank has come in to try to tackle this, and they do it by intervening in the currency markets by buying the yen, selling the dollar. And where do the Japanese bank get their dollar? They sold off their holdings or part of their holdings in US Treasury to get hold of the dollars, in which then they will sell into the currency markets. And this has caused the another problem, which is the unwinding of the yen carry trade. Now, this is not the time to talk about that because we don't have time for that, but just be aware of this unwinding of the yen carry trade, which is still ongoing because nobody knows how big is this yen carry trade. Some people say it's $1 trillion, some people say it's $40 trillion. So it will take some time for the market to fully understand what is the negative impact of the unwinding of the yen carry trade. Okay, earlier on, I did added one more slide this afternoon, and this is to show you who is holding on to the US national debt in terms of their treasury. Now, there's a pie chart on the left here. You can see that the US government's th- those that hold US government debt, the biggest pie refers to the marketable, meaning to say this can be traded in the secondary market. And the chart on the right shows you who is holding this 76.54% of US national debt, which are marketable. They are tradable. And you can see at the bottom of this chart on the right here, at the bottom is called foreign holders, referring to foreign central bankers. Okay, they hold on to US Treasury as they are deemed to be very safe investments, and they account for 33.5%. So it's a big chunk of the US Treasury that has been held by foreign holders. So if foreign holders are looking to divest from the United States, it will at some point cause the servicing of the US debt that much more difficult. Okay, so this is something that is ongoing. Do be aware of the trend. Okay, and of course, beyond the economics, we also must be consider that something that we need to consider is the geopolitics. Ever since the start of the war in Ukraine, we can see that the geopolitical situation has not de-escalated. In fact, signs are showing that it has been escalating. Now, today marks the 944 days of that war that is ongoing in Ukraine between Russia and Ukraine. The risk here is that the war now appears, or rather there are signs that the war is escalating. There's a risk that the war may actually spill beyond Ukraine, and if that happens, that will have a material impact on how market may react, because war are traditionally has been historically very inflationary. Okay, so if the war in Europe actually escalates, the inflation story will come back again big time. Okay, and if that's the case, the Federal Reserve would have to do another rate hike, basically reversing what they have just trying to do, which is to pivot by taking interest rate lower. So this is something that we have to consider because it is very real. Okay, now something to also consider is that uh, Ukraine has been striking deep into Russia, especially near to Moscow, and they are using weapons supplied by the West. And Putin recently has mentioned that if they have evidence that the West supplied weapons are hitting inside of Russia, he would take it as a declaration of war. Meaning to say that Putin now will have the basically the evidence to go after the places that they launch those weapons. Okay, so there is also another sign of the escalation in the European continent. Okay, something to watch. Now, while we are concerned about what's happening in Europe, the other place that is also troublesome is the Middle East. Now, we know the last October we have the Hamas actually raided into Israel, and it took a handful of more than a handful of hostages, and that trigger a retaliation from Israel, and that war has been quite devastating. Now that war has actually expanded because Israel is sandwiched between now on the left they have the Mediterranean Sea, at the south they have Egypt, Jordan on the east, and then they have Lebanon in the north. And it seems that Lebanon right now has retaliated against the attack on Hamas, on the Palestinians, and there is the risk that the war between Israel and Lebanon may actually escalate, and they have escalated. Now, Hamas are not a military force, nowhere in the scale of a regular army in Lebanon. Okay, so Lebanon definitely has more military might. Okay, and they definitely can escalate this conflict here. And we knew last week there was an attack on Lebanon using remote control, triggering of mobile devices like pager and walkie-talkies, for example. And this has actually caused serious damage to the Lebanon. Okay, so there is that sign that if Lebanon gets into a direct conflict with Israel, it may drag in the other countries such as Turkey. Turkey has already announced if there's a full all-out war between Israel and Lebanon, for example, Turkey is going to come to the aid of Lebanon, and that will be troublesome because Turkey is a member of NATO, and definitely this thing is not to be we shouldn't take it lightheartedly because there is risk that this may actually cause a wider conflict which will have a negative impact on energy supply because we know the Middle East is a major supplier of energy, and if that's the case oil prices may escalate to the upside, and that will again bring in inflation and which will have economic consequences. Now, one more thing that we have to talk about beyond the geopolitics is the domestic politics within the United States. We have a US presidential election coming up very, very fast, and there has been already two assassination attempts on one of the candidates, which is Donald Trump. And between these two candidates right now, both have very different economic platform. Donald Trump favors cutting taxes, for example, whereas his opposing side, which is Kamala Harris, suggests that she wants to hike taxes. Now, if the hike taxes is definitely not business friendly, Trump will be from the business perspective, is definitely going to be more business friendly because it's looking to cut interest rates. And if the Democrat candidate Kamala Harris actually wins this election, it will have a negative impact on the economy because she's looking to hike taxes very aggressively. One of the most controversial aspect of her taxation policy is to tax unrealized losses on investment. Now, this is unprecedented. Imagine if you hold a position and you have not closed out your position, even though there is profit, theoretically you don't need to pay tax on those positions. That may change if Kamala Harris comes into power. She'll want to tax those unrealized losses. So this will have a lot of implication if at the end of the day, if she win the election comes November the 5th, uh, there will be the risk that investor may actually start to uh, 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 close out their position before the year end. So this is something we want to watch. Now, there is also the risk because right now the domestic politics in the states is so polarized. Uh, the nation is actually quite divided between the Democrats and the Republicans. And I remember when Donald Trump lost the election the last time, uh, his supporter actually stormed Congress. Okay, so whether we're going to see something similar to this, we do not know, but there is that risk. Now, if Donald Trump, for whatever reason, lose the election, assuming there is no more assassination attempt on him, and this we could see a replay of this January 6th scenario. Okay, because I think there is a very great risk. Whoever wins the election, the the party that loses the election will not acknowledge the result. Okay, and that will lead to a risk of a civil unrest. Okay, and this is something that will scare off investor, and that is something that will have a negative impact on the economy. Okay, now again, we're going back to the soft landing scenario. Whether are we going to get a last chance to buy, because one of the most effective strategy over the years. Okay, I've been trading for almost 40 years now, and I started to trade the S&P 500 in the 1990s. And if you look back in those days compared to where the market is currently trading, last night there was an all-time high in the S&P 500. Can you imagine that? And one of the most effective strategy has been to buy the dip. Now, if there's going to be a significant correction, okay, leading into the election or post-election, okay, we are talking about weeks from now, maybe even days from now. If there's going to be a significant correction, would it still present a buying opportunity? We do not know. But historically speaking, every downtick has been bought up. Okay, the fact that we are currently at all-time high. Okay, in some of the major equity index in the states is telling us this strategy has been very, very profitable. Would that be the case going forward? We really do not know. Okay, so this is what I will be sharing with you, my outlook for the market itself. Okay, now how are you going to take advantage of all this volatility in the based on the factor that I just brought up to you? You can actually use one of the most successful product ever launched by the CME group, which is equity index futures. Like I mentioned, I started to trade S&P 500 back in the 1990s, where there is no E-mini, there is no micro E-mini, but you can see the notional value of all this index has climbed so much. Just to give an idea how much it has climbed, just from the March low of 2020, which is the pandemic low, currently the market has already doubled in value. Okay, so can you imagine back all the way back to 1990s, how many times has the stock market has doubled up? Okay, so that means those products that I was trading in the 1990s is no longer uh, uh, available to retail investors like you and me, because it's based on the value of the index itself. Okay, so the value index, the index itself has climbed so much to the point whereby based on the margin collected for this individual contract itself, it is basically beyond our reach. So the CME, which is the Chicago Mercantile Exchange, came out with a new product. They call it a micro E-mini equity index future, and it was very timely because it was launched just before the pandemic hit. Okay, you can see there was a lot of trading volume from that point onwards. You can see that the volume traded for the equity for this new product, the micro E-mini equity index futures, are actually exploded, and it all has got to do with retail investors. Okay, you can see that there are four basic, no, I won't say basic, there are four main products within this micro E-mini. Currently they add two more. Okay, but we wait for the volume to pick up for the two new products, which is the micro E-mini S&P mid cap and the small cap. Okay, so these are two more products within this family of micro E-mini equity index futures. We will concentrate on these four because this is where the volume is right now. Okay, now the contract, the product code, you just have to know that it's ES. ES in front is an M. ES means E mini, right? Okay, you can just add an M to the front. In fact, all of them have a prefix of an M. Okay, so you just remember the M in front is referring to the micro E mini, and the contract size is 1/10 the size of the E mini. Okay, $5 times whatever the value of the index, and the trading hours currently is fixed. Of course, that will change in November when we go back to non-daylight saving. Okay, and the minimum price movement for this product here is a quarter point equal to $1.25, and they are traded every quarterly from March, June, September to December. Last week we are still the active month was still September, but currently we are trading the December contract. So do be aware which is the most actively traded contract in which most of the volumes are concentrated. Now, in terms of settlements, these are financially settled, meaning to say if you're holding a long position at the last trading day, if you're holding on to a profitable trade, then your account will be credited with the gains. Similarly, if your position is losing money all the way into the last trading day, then they will deduct, okay, the losses from your trading account. Simple as that. There's no need to worry about delivery. Okay, and the termination is here. We can see on the third Friday of the calendar month itself. So coming up, we're going to have a quarterly settlement, meaning that every 3 months there is a what we call a triple witching day, and that is coming up very very fast, and that is usually the date in which we have massive amount of volatility, especially when the options are expiring. Okay, do watch out for that. And currently the maintenance margin for micro e-mini S&P 500 is $1,380. Now these are not cast in stone, meaning that they can change based on the volatility. Lower volatility, the exchange reserve the right to lower the margin requirement, but in cases where there is a spike in volatility, the exchange can, without notice, actually increase the amount of margin required to hold a position overnight. So always check with your broker what is the current margin required for overnight trade, especially if you're going to hold position overnight. Okay. Now the other most active traded contract, in fact, the most active contract in terms of volume is actually the micro e-mini Nasdaq 100 futures contracts. And again, this symbol is M and Q, and this is based on $2 times the actual value of the index, and the point value is different. Instead of quarter point $1.25 like the micro e-mini S&P 500, this one is quarter point move is equal to 50 cents. Okay, all things being equal, the margin requirement here is the highest at $2,100 as of today. Okay, now the other not so popular one, but we still have very very good volume, is the micro e-mini Dow Jones futures, and this is represented by the symbol MYM. And again, this one is based on 50 cents times the value of the contract. 1 point is equal to 50 cents, and the margin required is a lot lower at $980. Okay, and last but not the least, at sometimes the volume is even higher than the micro e-mini Dow. This one is the Russell 2000. Now the Russell 2000, for those who are not familiar, is actually a small cap index. Okay, so the symbol is M2K. This one is the valuation is $5 times the value of the index. 1 point is equal to 50 cents as well, and this one has the lowest margin requirement, $720 as of now. So in terms of volume itself, I will show you the next chart here, which is actually quite telling. Okay, based on what we see so far in the price action. Now there are four charts here. On the top left hand corner, we have the micro e-mini S&P 500. Now this refers to the volume and open interest. Volume is simple, how many lots change hand. Okay, so that one we can see that over the last week itself there is a quite a clear cut dip in the volume. But what is even more remarkable, there is been a sharp decline in open interest. Now open interest means the number of lots that has been carried forward. If investors are confident about a trend, it is almost likely that the open interest will increase. It has increased until recently. You can see there's a major downtick across the four equity index futures. There is a very clear and obvious decline in open interest, meaning to say that a lot of all these long-term trades are actually being closed out. So when you look at this, okay, there is some information here that you can infer. Earlier on, I did mention the S&P 500 is at record high as of last night. And if the market is going up, the volume and open interest is climbing down, and it's not just climbing down, it practically collapsed. Okay, it's showing that this uh, buying may not be sustainable. So this is a very important information that you can get from the open interest and volume. Just keep that in mind. Okay, meaning to say that the smart money is actually leaving the market. So this is something to consider. So when you look at the Nasdaq 100, which is very, very high volume, every day on average, you have 1 million contract being traded, change hand, okay? And we're also seeing a very remarkable dip in the open interest. In fact, as of last night, you can see open interest is at the lowest for the last 2 months. What happened in the last 2 months? If you remember, August the 5th, we have, in the week leading to August the 5th, we have a mini crash. Okay, market has since recovered, and some index has actually recovered more than the rest. For example, the Dow and the S&P 500 has managed to register fresh all-time high, but that is not correspond by the other index. For example, the Nasdaq 100, and it's definitely not corresponded in the Russell 2000. So we are beginning to see a bit of a divergence between the equity index here. Later on, when we go into the chart, I will show you what I think is happening. Okay, so this is a daily time frame of a S&P 500. Okay, this is still the mainstay. Now the S&P 500 can be defined as an index that's very popular with the retail investors. So anybody who trade retail tends to trade the S&P 500 relative to the Dow Jones. And the Dow Jones is actually something that only the money managers actually track. So retail investors do not normally track and trade the Dow Jones. So the S&P 500 has always been a very retail product here. So we can see the low on the left of this chart here is 2,300 points, and that was the low during the pandemic. March 23rd, that was the low. Okay, so we can see where we are right now as of last night. Closing is a 5,732, which is quite amazing, right? We can see the high traded is so many times beyond what we saw in the pandemic. Basically, it has gone up more than 1x. Okay, so we can see year to date, the S&P 500 as of last night was up 20%, which is very respectable. And when you compare that to the pandemic low, it's up almost 150%. Okay, so like I said, the strategy of buying the dip has been very effective since the day I traded this product, and it remains so. Okay, however, when we lay over the data set from the volume and open interest, it is pointing to me a very troublesome development. Meaning, say that the smart money is leaving the market, and who is pushing the market higher? I bet it is going to be make up of the retail investors. Okay, this is something that we all have to be aware of. If the retail are buying the high right now, that is something that you want to be very concerned with. Okay, this is the December contract for the micro E-mini S&P 500. This refers to the daily time frame. Now, the earlier chart that I show you is the cash index, which you cannot trade. Okay, however, that is the underlying. So this is the futures contract that you can trade. Okay, so we can see last night we have a high, so we can see that the market is trading higher. That has been the case since the low that was traded late in October last year. Remember what was the narrative back last year? There were a lot of talks about the Fed imminent rate cut. The rate cut has been the narrative that pushed up the equity markets, and it's only last week the Federal Reserve finally actually cut. So the market has bought up the equity markets because they believe rate cuts is actually friendly to equity markets. Now that may be case in the bull market in which we are in right now. Okay, but if the rate cut happens on fear that the U.S. economy may slow down, that is not a positive development. Now, in a very strong economy, rate cuts is going to be the rocket fuel that will take equity markets much higher. However, in an economy that has the risk of actually softening, that is a sign that the economy is in trouble. A rate cut now is an acknowledgement that the Federal Reserve now realize the economy is in trouble. The fact the Federal Reserve cut by 50 basis points instead of 25 basis points could be a sign that the Federal Reserve finally recognized that the economy may not be as strong, especially after the report last month in which the Bureau of Labor Statistics revealed that they have created less than 800,000 jobs compared to what we were told. Okay, so this is something that we all have to consider. What I'm trying to say here is that uh, while you are buying, okay, this index ever higher, be aware that the risk now has increased dramatically because we can see that the open interest has practically collapsed. Okay, just be aware. And here there is an indicator at the bottom here. Now this indicator is something that I like to use to see if the market is sustainable, whether it's going up or whether it's coming down. You can see this phase here where the index is actually increasing. Okay, this does not refers to that the market is strong. It just confirms the trend. When you correspond this index to the price index, you can see that the phase here is actually very strong until it peaks. You can see the peak in this index correspond with the top. Okay, so currently we have a bit of a run up in prices, but the index is not climbing. So this is telling me there is no momentum behind this rally here. just be aware. Okay, just an observation. I'm not saying that the market is going to collapse anytime soon. I'm just saying that it has no underlying momentum behind it. Now, this is the 4 hours time frame of the same chart that I showed you just a while ago, and where the market traded to last night actually is a very low risk trade setup, and meaning to say that it favors trading counter trend. The underlying momentum is high. Okay, meaning that the market has a higher risk of actually continuing to run higher. However, at where the market is right now, okay, there is the possibility of doing counter trend trade. Now, how do I know whether it's good time to trade counter trend? Based on the risk reward ratio. Here you can see the risk reward ratio is one is to 7.2. Meaning to say that if I'm prepared to go and sell right now, okay, for every $1 I am prepared to lose, I have a chance to make $7. Okay, so you can see this is something that I'm not asking you to do this trade. I'm just saying that based on this strategy that I use, okay, I should be already short this S&P 500. I have put my stop just above here. If the stop is taken out, I lose $80 per contract. But if I'm right when the market hit my target, there is a possibility of me making 7 times more than I want to risk. $572 profit relative to $80 risk. I think that is a good risk reward ratio. Okay, it's something that I would do. I'm not saying that you should do. I'm just saying that this is what I will possibly look at. Okay, now when we look at the other index, which is very, very popular right now, we can see that the structure of this move here looks a little bit different. Now, again, from the pandemic low at 6,771, we are now above 20,000. But you notice that the high here, the all-time high, was actually 2 months ago. Last night, the S&P 500 hit an all-time high, but the Nasdaq did not. Okay, and over the last few months, the narrative in the market is all about AI. The market started to rally last October, okay, all about ChatGPT. ChatGPT came in about the time last year, about 1 year ago, and we can see that that has been the story. And when the AI narrative become prevalent, you can see that the market was all about buying tech stocks. And Nasdaq 100 is a sub-index of the Nasdaq Composite Index, and it has a lot of tech company inside this index here. Okay, so that was the push to the all-time high, but that happens on July the 10th, which incidentally was my birthday, and the market has not come anywhere near those numbers. Again, okay, there has been a bit of an uptick of late, but it is nowhere near the all-time high. It's definitely not at the high. Okay, so this is something that you have to consider, and this is the cash index. Now let's take a look at the futures contract. Now this is the December contract for the micro e-mini Nasdaq 100 December contract. You can see that based on the daily time frame, the market has been doing this three-wave pattern. Now a three-wave pattern, okay, for those who are familiar with Elliott wave, okay, this is a corrective pattern. Equality is not that far away. Meaning to say, if you took the entire move from this leg here, extrapolate from the low here, you get equality. We are very, very near the equality, and to see whether the market is actually supported. There is no sell signal right now. Okay, maybe as of last night, there's no sell signal, and we also see that on the daily time frame, the index here has not been climbing. So that is telling me this move up here, although it looks very strong, okay, has not been confirmed by the momentum indicator in the ADX. Okay, this is troubling for me. It on a lot of front. Okay, I would not want to buy this index based on the idea that there is no momentum behind it. Now, this is the 4 hours time frame of the same chart here. We can see that despite market going up, okay, there is no climbing in the ADX. I need to see the ADX climbing to confirm that the trend is in place. Now, if the market goes down persistently and it accompanied by a rise in the ADX, that means to say I want to be trading only on the short side of the market. Right now, the market is not telling me that it is sustainable to the upside. Okay, but there is no sign that the market is about to topple yet. In fact, there is no counter trend trade as of last night. So keep it means to say for now, I have one trade idea for the S&P 500, but I have nothing in the Nasdaq. So I will just continue to watch. Okay. Now, when we look at the other index, for example, the next best one, it is the Dow Jones. Now, again, I want to inform you, Dow Jones is actually an index followed by money managers around the world, and this is something that we want to consider. It is an all-time high. Okay, and it's at 42,208. Now, this is very far away from the pandemic low. Okay, as far as the pandemic low is concerned, the market has already gone up by 131%. As of this year, it's only up about almost 12 as of last night closing prices. So this is the cash index. We don't trade this. Now let's show you the futures equivalent. So this is the futures equivalent, the December contract for the Dow Jones futures. Again, this is telling us the market is very, very strong based on the price action. However, the index is only marginally climbing. Okay, the angle in which it is climbing is not acute. I need to see something like this, 45 degrees. Okay, during this phase, if the index is climbing, you can see it's corresponding with the strongest phase in this up run. Okay, so the moment it start to pick, you can see that it corresponded to the temporary top. The market did not collapse, but it has actually stopped rising after the ADX pick. Okay, since then we don't see a very strong uptick in the ADX. So again, I want to be very, very cautious. There's no sell signal in the daily time frame. However, the same cannot be said of the 4 hours. The 4 hours here in the Dow Jones futures, we're beginning to see a counter trend being developed. Okay, however, uh, not able to get into position just yet, but there is a counter trend in place. We want to see over the next few days whether the market go up higher to go into this bracket of prices. If it does, I am looking to sell at 42,604 in the futures contract for December. I'm going to put my stop just above the all-time high at 42,657. So it's very specific. If I'm wrong, I stand to lose $26.50 per contract. But if I'm right, the market goes down to my target, I have a chance to make $168. So it's definitely a good trade. The risk reward ratio is $1 risk to potential to make $6. So this is again something to consider. I'm not asking you to trade this position. Now, the last, not the least, is going to be the Russell 2000. This is the cash index. Now, this has everything to do with the Fed pivot. Okay, in a environment in which interest rates are expected to be lower, it it will impact different uh, equity markets very differently. Okay, it will not necessarily be a boom to, let's say, the Dow Jones or the S&P 500, or for that matter, even the Dow, the Nasdaq 100. Okay, but it will positively impact the small cap. Russell 2000 is a small cap index. Okay, so we can see that it was already a big sharp move here. Okay, when they were when the non-farm payroll came in and showed that the US economy is not producing enough jobs, there was a spike in the Russell 2000. And this is very, very sharp. Later on, when you go down the daily time frame, you can see that move here. Okay. And that is trying to tell us any rate cut will positively impact the small cap more than the other mid cap and the what you call the bellwether index like the Dow Jones. Okay, so we can see that the Russell itself uh, has only gone up by less than 10% this year. It is the least among all the major equity index. From the pandemic low of below 1,000, now it's above 2,000. So it's actually been going up. But you can see that the chart looks very different. Okay, it doesn't have the sharp move that we saw in the S&P 500 or the Nasdaq during this phase. Now let's go down to the futures contract here, relative to the December Russell 2000. The symbol here is M2K, and this Z refers to December contract. You can see there's a very sharp move here. Okay, when the non-farm payroll came in July. Okay, in August for July. So we can see that since then the market has come down, and you can see there's a very sharp drop here. This is the reaction to the unwinding on the yen carry trade, but it has basically recovered back almost everything. In the daily time frame, we already have a counter trend trade. Okay, if I'm trading this on the daily time frame, I'm going to hold position, I should be already short. Okay, because the market goes into this bracket of prices that favors going counter trend. Okay, so when we look at the 4 hours time frame, which is the lower time frame, this is what would have happened. Okay, the market has gone back up here last uh, uh, last Friday. The market gone into very deep into this area here, which is a very low risk environment in which if I am trading this product here, I'll be already short at 2,250.4, and my stop remains at the all-time at this high here. Okay, which is the stop should be at 2,320.6. and if I'm wrong, I stand to lose $350. But if the market goes down to my target here, with somewhere inside this bracket here, at equality level, I stand to win about $1,300. So the risk reward is not as great as what we saw in the S&P 500, which is 1 is to 7.2. This one is 1 is to 3.7. For every $1 that I'm prepared to lose, there's a potential to make $3.70. Okay, so based on the risk reward ratio, it doesn't look that great, but this is the only index that has shown me the cleanest structure among the four equity index. If I'm going to be selling, this will be the one that I will be considering. Okay, so this is just my opinion as to what I want to do. Okay, I'm not saying the market is going to collapse. I'm just saying that the market comes into a situation in which trading counter trend now seems to be more advantageous. Now, the date to look out for, which I think is going to be very crucial. Remember, I did mention the triple witching day will happen on this particular day itself. Okay, this will be actually it's going to be this Friday. This Friday, that was last week. Okay, last week in which we have triple witching, which also explains why we have a collapse in the open interest. But going into the end month here, there is going to be quarterly options expiring, especially in a lot of asset classes. So this will be a date to watch, which is next Monday. Okay, because it's the end of the month and the start of a last quarter for the 2024. So watch out this date. Something I do expect an increase in volatility. Okay, just watch out this date. Now, if you want to get more information about the product itself, you should go to the website. CME has a fantastic website where in which they have a lot of resources in which you can tap. There are courses to take, there are webinars to attend, and there are expert opinion being posted on their website here. Follow the link, go and explore, and there's even a trading simulator. If you want to test out a strategy, you can trade it, you can test out on your own platform, but you can also use the CME trading simulator to actually test out a strategy before you put real money behind it. Okay, and this is also part of their resource. This is their wherever there is expert opinion, you can also follow this link here. You can see it's insights. Okay, whereby they get expert analysts to give you their take on the current market for all products that is available for trading on the CME website. Okay, not just equity index, you can do anything that you want to do research on. Okay, now I know there is going to be a Q&A which we'll be talking about right now. Okay, so if you have any question that you want to ask me, so this is time to post your question to me, and I will take your question from here. Brian, you want to get me the questions?
Yeah, sure. Yeah, sure. Okay, so I'll just share my screen real quick. It's at the end of your presentation, Daniel.
Yes,
You have
correct.
more things. Okay, cool. So I'll pass it back to me right now. Okay, and we'll get straight into the Q&A section right here. All right, thank you, Daniel. So yeah, if you guys have any questions that you would like to present to Daniel, you could type them there. If you're on mobile, there should be like a chat box icon at the bottom of your screen. If you are on desktop, it should also be somewhere around there. So okay, I have one here, which is NFP means that they have omitted farming jobs. Is that right? Do we take, as retail investors, do we take into account the farming jobs, or does the Fed take them into account when looking at what to do?
Okay, if you're talking about employment situation in the States, the non-farm payroll has always been the go-to number to look at the number of jobs being created. Obviously, in a healthy economy, more jobs will be created. In a less than ideal economic situation, less job will be created. And the fact that all the headline non-farm payroll numbers has been revised largely downwards in subsequent updates is definitely not a sign that the US economy is reporting a lot of good jobs. In fact, they have not created that many jobs. And among the jobs that are being created, a quarter, 25%, 20 to 25% of them are jobs going to governments, meaning to say whether you're working for the federal government or whether you're working for the state government or the municipals, those jobs do not create the same kind of economic benefits, unlike jobs being created, let's say, in manufacturing. Okay, so we can see manufacturing has not been performing very well. All these talks about reshoring manufacturing back to the states is not working out as planned. Okay, and governments is actually creating more states and federal jobs, and like I said, those jobs do not create the economic benefit like a plain vanilla manufacturing jobs. Okay, so from among those numbers that we see, jobs are also created for illegal migrants. A lot of jobs goes to illegal migrant, which is capturing most of the gain in employment. So that means by inferring that more jobs are created by governments and for illegal immigrants, it means the regular Americans, those Native Americans, I mean those born in the states, are not necessarily included in the growth in employment. So this is troublesome on many fronts. Okay, so when you look at the non-farm payroll situation, the fact that it has been revised drastically downwards. In fact, right now they have been telling us that they created less than 800,000 jobs. That is troubling to to a lot of investors. So this is something that we want to look at. The non-farm payroll is, of course, only looking at employment gains other than the farming sector, which has been very volatile.
All right, thanks, Daniel. Okay, we have another question, which is, oh, so do you think that after the recent rate cut, do recession risks still remain? If so, is it expected to hit hard as previously after rate cuts there is a possible rally for stocks and indexes?
Okay, based on price action, markets appears to be very strong. Okay, because after all, the fact is the Dow Jones and the S&P 500 are at record high as of last yesterday night. Okay, so things may change very fast. Well, I'm very concerned by the collapse in open interest. Okay, and the dip in volume. Now, what we want to see in a market that is trending in one direction, not necessarily up, but trending persistently in one direction, is usually accompanied by increasing volume and increasing open interest. So right now we have price action at all-time high in the S&P 500 and the Dow. Okay, but we can see volume is actually tapering off, and open interest has practically collapsed. So this is not the the environment in which you want to see the market heading. In any strong bull market, we want to see a rising volume, rising open interest. Similarly, in a market that is that's coming down very aggressively, volume and open interest will also increase. But right now, we are seeing price action diverging from the open interest and volume. So this is a red flag for a lot of technical traders. So whether or not the US will go in, whether the US economy will go into a recession, I think there's a very high risk of that. Okay, because not only are we looking at US statistics, the global economy is slowing down. In Europe, we have the latest number coming in from Eurozone itself. Basically, their economy is the entire Eurozone is not doing well. Japan is not doing well, and no, China is not doing well. So it's going to be very difficult for the US economy to continue to be strong, okay, because globally we see a marked slowdown in global economy, and this eventually will mean US economy will be affected. Okay, so again, when we look at the unemployment rate, the high traded was at 4.3%. Okay, 4.3% is a number that is historically speaking not very high, but throughout history, whenever unemployment rate hit 4.4% and stay above that level, it almost always lead to a recession. So the risk of a recession is actually very high. Okay, so just be aware that the signs are not great, okay, for a sustained rally in equity markets. A recession is a very real risk, especially if we include the possibility of an escalation in the war in Europe as well as in the Middle East. Okay, if crude oil prices starts to rally very aggressively, you know, it will definitely dampen economic activity within the states. So yeah, personally, I think that the risk of a recession is actually very real, especially if next month's election didn't turn out well. Okay, and Kamala Harris actually wins the election based on her economic platform. Okay, there is a risk of investors trying to divest from the United States because of the increased tax policy of Kamala Harris.
All right, thanks, Daniel. We have another one, which is normally a rate cut weakens a currency. However, the dollar index was ranging and instead gained some percentage even after the rate cuts. Is there a tip to, is there a tip to navigate structure when price action is ranging after such a news release?
Okay, I assume you're talking about the dollar index here, because the dollar has not risen against all currency. Okay, against the major currency, for example, the sterling pound, the dollar is actually retreating. But against the yen, for example, dollar yen has been rising, and that also impacted the dollar index performance in terms of price action. Yes, there has been an uptick in the dollar over last week. Okay, but when you look at the prospect of more rate cuts, the market do expect the Federal Reserve to continue to cut rates. Of course, next month there is no FOMC meeting. The remaining two FOMC meeting will be in November and December. Okay, so market is already expecting more rate cuts to come. Okay, in fact, there are some analysts expects US the Federal Reserve to actually cut rates to close to 4%, even below 4% by the end of this year. So that means if that is the case, currently we are 5% right now. If they want to bring interest rates down to 4%, meaning to say November they will the market is expecting another 50 basis point cut, followed by another 50 basis point cut in December. So if that is the case, instead of being bullish, I would think that we're sending a very clear message that the U.S. economy is in deep trouble, because when the Federal Reserve cut as deep as it is, okay, it's telling us they are concerned, and that will mean lower dollar rates. And if the dollar goes down because of interest rate going down, that is the normal correlation. So I think if the expectation is more rate cut, what we see in terms of the bounce in the dollar since last week may not be sustainable. Okay, so because the general mood of the market right now is for more rate cut, and more rate cuts means lower dollar rate. Okay, so this is something that we will have to consider. Day to day, there will be different interpretation, but over the medium to long term outlook, if the market expects more rate cuts, definitely it will mean lower dollar rates.
All right, thanks, Daniel. Okay, do we have any other questions for Daniel before we cap the session here? Any other questions? The session will be recorded and uploaded to YouTube tomorrow, so you can see the recording there. All right, so I think that's all for the questions. Okay, so I think I'll just move on to our next section. Okay, so thank you, Daniel, for answering all of the questions, and also thank you to the attendees for asking and providing feedbacks and questions. All right, so if you have any other questions and inquiries, you could definitely send an email in. But if you are interested in opening an account with us to trade stocks, futures, or CFDs, you can do so through this QR code right here. You can open all of these accounts through this one link and through this one portal. It's completely free of charge. There are no costs for you to open an account. Or if you don't know, how to open the account, or you have questions and you need someone to answer you, you can definitely reach out to our email, pcsb underscore inquiry at flipcapital.com.mine. We will answer your inquiries there. The email is also posted on our website. Personally, I think that this is a great time to open an account, seeing as we have many promotions ongoing at the moment. So you can get a lot of cashback rewards or even lower commissions and rebates for products. So definitely do give our website a look. All right. Now, if you have any other further questions or if you'd like to know more about our company and our products, you can contact us here. We have media presence on many different platforms such as Facebook, YouTube, LinkedIn, and Telegram. We also always post content on our Instagram page. And most importantly, all of the information is aggregated on our company website, flip.com.my. So you can find all of the information that you need on there. And if you want to contact any of the branches near you, you can drop us a call or even drop in an email where this is the page where you can see all of our contact informations right here. You can drop us a call anytime from 9 a.m. to 6 p.m. Monday to Friday. We will have dealers to assist you at any moment. Okay, well, uh, that is the end of our webinar. Thank you all for joining, and thank you, Daniel, for your time. It was a pleasure hosting you, and I hope all of you gained valuable insights from his presentation. All right, thank you all. I will see you guys in the next one. Take care.